Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about AITX, going over their 2022 Q2 results. Every time there's some results, I have a couple folks who ping me, ask me to go over it, so I'm going to go ahead and proactively do that this time. Sorry, my webcam setup is broken today, so you will not be seeing my face today. I'm going to try to get that fixed soon. Anyways, let me remind you before I begin that I am not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I do not hold any position in AITX, so this video should be for your entertainment purposes only because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. So, these results were just released, I believe, on Friday after market close. So I want to go over it today. AITX, right off the cuff, it's not good. Revenue growth, just here's the Cliffs Notes, right? Revenue growth is slowing, and in fact, revenue from rentals are actually down quarter over quarter. Debt is up, interest payments are up, cash is down, and they are burning about $1 million per month, in that vicinity of actual cash. And the revenue growth and the profitability is, just can't catch up quick enough to actually offset that. So we go through more details here to give a little bit of, give some of the underlying data there. So just starting off the bat, this is a chart that I have. Maybe I can zoom in a bit, make that a little bit easier for you to see. This is a chart I put together. I have their results from a whole bunch of quarters, right? All the way going back to 2019. Obviously, the right side of that graph is a lot more relevant, than how the company was doing years ago. You can see how their revenue has been going up. Just the way to interpret this graph is that there is this is a stacked area graph, and the red and the blue add up to be their total amount of revenue, right? So the red line here actually, if you're just looking at that number to see what the revenue has been in each quarter, that does show you it there. And the blue line shows the portion of the revenue that was from rentals, and that's sort of the underlying basis, the base of their revenue that you would want to see going up and up and up over time as sort of a the base of the company, providing the bulk of their future looking revenue that they can rely on. And you can see here that both the red area is drastically decreased from the past 3 quarters. It is closer to the quarter 1 year ago, where there was not a whole lot of direct sales of goods or services. But then there was also the blue line that is the actual rentals, and you've seen that has had this steady increase over time. It did actually slightly go down in the quarter a year ago, but then you saw it again go down this quarter over quarter. And I have another graph to sort of show that. But the point is, revenue went down this quarter. The actual numbers, I can scroll up and get them, was that last quarter there was total $385,000 of revenue. This quarter is down to 267, so that was a bit of a decrease, and that was their lowest quarter in a whole year. You can see here that they were in the high 300,000s for the prior 3 quarters, and this quarter was in the mid 200s. And then even rentals, right? You can see rentals had been growing every quarter until then it was down by about $10,000 from last quarter, which is not a large. It's a small decrease, right? It's actually not that much. However, and I'll talk about this later, that AITX, the valuation had basically assumed that AITX was going to continue growing and growing, and when we see this flatten off and even go down, this does not paint a very good picture. I'm gonna get into that in just a couple minutes. If I average this out by looking at trailing 12 months revenue, you can see that they are still up, for the trailing 12 months versus when they chopped off the quarter from a year ago and added this quarter on, but it's not going up nearly as quickly as it was. And if we look at this here, this is the graph that I did want to get to. It's a little too big. Let me make this just a tad smaller so you can see it a tiny bit better. Thanks, Google Sheets, for not cooperating. Anyways, I'm gonna try my best here. So this very last quarter, you can see these lines. The red line is showing the quarter over quarter rental growth, right, in terms of percent, and the blue line is showing the actual revenue growth. And you can see that this quarter, those both crossed over that zero line, and now we're negative quarter over quarter. And you can see that hasn't actually happened very much, right? They have been growing quarter over quarter pretty consistently, especially that rentals. You can see those rentals, it did dip just slightly negative a year ago in the same quarter, but this is not a good sign at the current moment for that to actually be going down. The gross margins were actually up. I think this might have been the highest quarter in terms of gross margins, and this actually matches kind of what it matches the statement that is in there. I can't recall if it's still in this 10Q or in others where they kind of say they expect 75%. I'm never going to find it. Gross margins. There's some verbiage in either in here or on the 10K, and I don't recall because I've read their 10Qs for a year now or so, where they say something like they expect higher margins on the rentals versus the direct sales, but I think 87% is, as I have here on the graph, a new high in terms of gross margins. That's good. But although let me put a caveat in that and say that I've gone through some of their accounting, and I do not believe that these gross margins are reflective of what you would normally think of as gross margins. I have a whole video on that from, I don't know, 6 months ago or so. If anybody's curious, ask in the comments. I'm sure I could give you the link to it. But I'm just not sure these gross margins are actually reflective. Anyways, couple other things that I wanted to call out here. Let's go to the actual report here. Their cash is very low, right? They're down to $300,000, and you can see there's a number of other liabilities that are up. Accounts payable is up, and really the big ones that matter down here, you can see they are just growing and growing in terms of debt, and they even have more accrued interest, right? That's going up here, that they need to pay and they haven't paid, right? And this is up even since the beginning of the fiscal year in February, whereas $1.8 million now it's $4 million here, and so that's a lot of money that's been queued up. They don't have the cash right now to do that, and even if they are, I'm getting a bit ahead of myself. So let's go on a bit of a deep dive on their actual accrued interest payable here, and I have put it together in a graph to show what this looks like. And so they had been accruing some interest, and then they actually got it either paid off or exchanged. I can't recall what happened, in beginning of 2021, but they basically got this reset, and now it has just been growing and growing and growing, and you can see that this is just going up quarter over quarter, and so they have more and more accrued interest payable that they haven't paid, and now it's getting to a point, once it's in the couple $1 million, like that's a lot of money for this company. When their revenues are their trailing 12 months revenue were about less than 1.5 million here, right? I can actually grab the number if I scroll up here. Trailing 12 months revenue for this for this quarter were $1.4 million. And we go back over here to look at their accrued interest. They have $4 million. I guess I can just go here. $4 million of accrued interest that they need to pay, and so that's not a great situation. If we take a look at their loans here, I copied this all out and did up the math, and they have in total, this number is not correct. In default, we don't do this in default here. That doesn't matter, but in total, they have, I think, about $28 million of debt. We can actually scroll down here. They list it all out. It's actually quite, it's a lot of disclosures. It's very nice to see here. And yeah, so the total principal amount of all of this debt that they have here is $28 million, which continues to grow. And I did not get the graph put together to show how this number has grown over time, but suffice it to say, it has. And it's even up about $3.5 million, I think, quarter over quarter. And not all of that was actually new, wasn't new debt that was issued. They did an exchange from some warrants into debt. And I think that was this $3 million here. And that's kind of, 2 years to pay back those $3 million seems not credible at the current moment, right? They're going to have some major revenue growth. And in the past, they've called this out as something that could be plausible, but we just haven't seen it. We're not seeing it materialize when the revenue growth is, flat and even down a little bit. But the important thing out of this is that their monthly interest that they have to pay, if I calculate it just off of the loans that they have called out there, and this is all their loans, and then the interest rates, you multiply that out, add it up, and they're paying $273,000 per month in terms of interest on this, right? And so this is per month, not per quarter. So you multiply that out, it's what, $800,000 per quarter, and this is a company that's making $267,000 in revenue. Even on one of their good quarters where they have a lot of extra sales, they were making $500,000. They're not even covering the interest on this loan. And so this is, again, the only way out of this for them, the only plausible way that I saw for them out of their current financial situation was to really, grow revenue at a very, very high amount. If they can keep growing, they'll be able to keep borrowing more in order to fuel that growth, and they could actually pay off this debt and start to get into a better situation. But as it looks here with that drop off in revenue, it doesn't seem like a very credible story anymore. And I'm seems like the company, I stand by kind of my gut feel when I started looking at this company. It seems like things have gotten worse since then. That bankruptcy, I think, is on the table in the next year or so. I'm actually surprised that they were able to get any new loans. They actually got not a lot, compared to what they have, but they were able to get more. I believe both this $500,000 here and this $619,000 here were new cash coming into the company during this quarter. And so they did get over $1 million in terms of loans. Now, they have also been, obviously, for anybody who's followed the company, they've also been issuing shares. They've been diluting, and they were able to pull in, let's see, I want to say it was, let's scroll down. I think we can find this. Let me see if I can find it. Proceeds. Oh, net proceeds. There we go. And so this tells you for the 6 months. I guess it doesn't actually split out these 3 months here. No, it doesn't. I actually did the math, so I'll just refer to my notes here, even though you can't exactly read it off the 10Q. During this quarter, they issued about 191 million shares for net proceeds of about $1.9 million. So they were getting just about 1 cent per share. This was, if I eyeball it, about a 10% discount to their trading value over the quarter. And so, if you look forward and figure, their current trading price of, what is it, 0.7 cents, I think, and you figure a 10% discount off of that, and you look at the amount of shares that they have remaining, which is, what's that, roughly 850 million shares or so. They really only have runway of about $5.5 million with their current authorized 6 billion shares. And that's assuming that the stock actually stays flat. If this dilution causes more selling pressure on the stock in the open market and pushes the price down, that number of 5.5 million in terms of, the cash they can bring in is even lower. And I think I mentioned up front that they are burning about $1 million per month in terms of cash right now, and they have next to no cash on the books. So it was $300,000 right now, and so it's kind of a timing game in terms of what they can do with all of this stuff that the liabilities they have, right? The accrued interest they already have, the interest they're paying month after month and all the expenses that actually run the company. If you do the naive calculation, they're 6 months from bankruptcy at, with some optimistic assumptions in there. But you never know what's going to happen, right? They've actually lasted longer than I thought they were, but I just don't see that things are looking very good for the company, given these numbers. Again, we could see, major revenue growth. It's not impossible, but for a lot of the other things that I see in terms of closing deals and some of the stuff that they're doing to optimize costs, like on paper, or I shouldn't say on paper, I should say in theory, those things make sense. But when I look at the numbers here in terms of how do they actually perform in Q2, it just wasn't there, right? Revenue was down, not up. And so that's unless that trend reverses, unless revenue really goes up and they're able to start bringing a lot of money into the company to at least start treading water and keeping things sort of at zero while they can grow and refinance debt. I do not think this is going to last very much longer. So that is my take on their Q2. Let me know if you have any questions or comments down below. I would love to hear your feedback. Thank you very much and have a good one.